E&J Capital. Like, subscribe, comment. Today's video we'll be talking about what type of investor are you? In my mind, there's three different types. There's the passive, there's the active, and there's the trader. Passive investors are the most laid back. If you plan on being in the market, but you don't want to be 100% in the market, and you just want to invest for long term, you want to be a passive investor. You want to buy and hold index funds. You shouldn't even touch mutual funds because they never beat the market and they have high fees because they're professionally managed. Instead of mutual funds, just buy index funds, Vanguard, any ETF that tracks the market. You'll have a better chance. Less fees, you'll get to keep more of the returns. Passive investing, there's a lot less risk because you're in it for the long run. You're okay with the fluctuations. You probably barely even check the market. It's not that serious to you. It's like a second savings account that you just don't touch. As it grows, you get dividends. It just starts to build over time. It's not as fast as taking on more risk, but you sleep better at night. And then there's active investing. Active is more hands-on approach. Not as hands-on as trading, but not as laid back as passive. It's more of, you're doing your research a little bit. You might buy index funds, but you may also buy individual stocks that you believe in long-term success. You may even start touching options, where you're doing option strategies like covered calls, like if you have 100 shares of stock and you sell calls against them, or you start hedging with downside protection, more of a hands-on approach. And in my opinion, that's probably the sweet spot between the two. You're invested in investing, if that makes sense, and you want to get better, you want to generate higher returns, and you don't want to just like sit back and watch, and hope that the index funds goes up and the economy continues to grow. You could do covered calls, cash secured puts, try earnings plays, selling options during earnings when IV is high. You could, start shorting stocks. You could start touching futures, but you may take on swing trades where you buy and hold for maybe a few weeks. And then there's trading. Trading is the act of getting in and out of a position within the same day or just to the next day. It's the most risk. You could potentially get large rewards. That's when you're into day trading. You're into options day trading or short-term options trading. You're into trading earnings events. There's earnings events pretty much every day, so you always have a position that you could do. The thing with trading is you're always going to be a little bit stressed out. Even the most experienced guys. There's guys on Wall Street that still jump out of buildings because of bad days. That idea that there's no stress in trading, that there shouldn't be, is out the window. If you're experienced, you're putting money on the line, it's your own money. It gets a little less stressful over time as you get more confident. You know how to take on less risk, but the stress will always be there because you're putting money on the line. Like back in the day when you're playing ball with your boys, they start talking and then somebody with a big mouth says, "All right, put some money up." What happens? Foul here, flagrant foul there, slapping everybody, like the old no stitching policy. Everybody knows what happened, but nobody saw it. It gets real when the money's on the line. Unless you have a computer to do it for you, if you're good with coding and you could write scripts of, what you want the play to be, what your trades to look like, that will reduce most of your stress, and you could, you won't have to be fully invested like if you're manually trading. You got to treat trading like a business. You want to read Bloomberg. You want to know everything about the financial markets. You want to know everything about what's going on in the markets, what's going on with the president, what's going on with the economy, upcoming economic releases like job reports or employment data. It's important to know. And if you don't take it serious and you don't treat it like a business every day, you're going to fail trading. It's not something you could just passively be like, okay, I'll just do this, blah, blah, blah. With trading, you could beat the market 100 times over. But with buying index funds, if the market goes up 10%, you're most likely going to go up 10%, which is really good. It's better than the less than 1% your savings account will get. Active investing, you have a little bit more chance of higher than the annual return, but you're taking on more risk to do so, so you may not hit it. Trading, you could make 1,000%. People that say, oh, hedge funds can't beat the market, blah, 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 they're dealing with billions of dollars. If you're dealing with billions of dollars, I'm probably not speaking to the right people. Or I probably am. Slime me some. The smaller guys Guys like us who don't have $5 million to trade with are known as retail traders. We don't trade for a bank. We don't trade for a hedge fund. We could do more because it's our own money. We could do a lot more than the next person. Take on more risk. You can make more rewards. Just because the hedge funds don't beat the market doesn't mean you can't. Those people with that mindset, get them out of here. They don't know what they're talking about. But as an investor, right, you look at either two things. You look at fundamental analysis or you look at technical analysis. Fundamental analysis is looking at how the company is, how healthy the company is financially. Cash flow statements, balance sheets, all the numbers. You know, they look at past earnings, how they're projected to do in the future, its competitors, where they are in the sector, how much risk they take on every year. They look at the numbers. And then there's technical analysis, where you're looking at the charts. You're looking at support and resistance. You're looking at where price is sensitive, where the market is going, if it's uptrending, if it's downtrending. If there's volatile moments in the market, you want to know about that. You want to know about volume. You want a stock that's a little bit more volatile. Good books on fundamental analysis is Security Analysis. That was my favorite book. Up on Wall Street, that was one of the first books I read. There's Intelligent Investor, which is not a good beginner book, because if you read that first, it'll turn you off to the markets. It's a little outdated, but there's a lot of terms in there that if you don't have an accounting or finance, any background in finance or accounting, it might confuse you a little bit. We'll get into more about fundamental, technical analysis, how to read balance sheets. Technical versus fundamental, I wouldn't say there's one that's better than the other. They both, could help you in investing, in trading. I think fundamental is better for long-term investing, and I think technical is better for trading. You can't really switch over. Just because somebody's fundamentals are good doesn't mean that's the right play for today. Passive, laid back, buy and hold, long-term, give them to your kids, give them to your grandkids when you're older. Active, a little bit more hands-on approach. You're buying, selling, maybe swing trading where you hold it for a few weeks, maybe short selling, maybe options, maybe futures. Day trading, most risk, highest potential reward, 100% fully invested. Treat it like a business. E&J Cap.